Thanks for everyone for coming online for today's presentation. Very excited to give it. My partner on this, Ed, he unfortunately couldn't make it today, so I'm solo on the presentation. But Ed, if you decided you wanted more information on any of this, Ed is the person that you would be going through asking for more questions. Looking forward to having everyone online. So let me just get the presentation started. Let me share my screen. Okay. And let me get the slideshow started. Okay, so you may, and I should back this up. So my name's Alex Wilson, broker owner of Remax Wealth Builders Real Estate, and over the past, let's see, I started investing in 2012. So over the past 12 years, I started investing in Toronto real estate, moved into Calgary real estate, and between those two locations, I've built a portfolio worth $20 million. And then one day, I started talking to Ed Scott, and we were talking about the UK market and pre-construction in the UK market. And then this other opportunity came up, and he was telling me that you can get 9 to 10% rates of return on your investment. And we got into more detail, and it's the closest I've ever seen to something that I call a guaranteed rate of return. I don't like using the word guaranteed, especially for a rate of return, but this is the closest that I've ever seen to a guaranteed rate of return. And it's a pretty incredible vehicle, and you own it. Like it's in your name, not something where you're funding a developer or anything like that. So I find it really interesting. So here's what it is. You can invest in the UK, and it's called a social housing initiative program. And essentially what you do is you buy a fully renovated property in the UK, and then that property is rented by the city from you. So the city rents it. So that's the city signs a lease. It's a 25-year lease. And that's your guarantee. So you know that the property's leased, the city is paying for the lease, or as they say in the UK council. And you own the property in your name. You have this guaranteed monthly income that's coming out, and it's indexed to inflation as well. So every year that inflation comes in, your rent is going to go up. So you're going to get an increase in rent, even though you have the signed lease. So the increase in rent is indexed to inflation. Plus, with the lease, the tenants, which is the city, is responsible for repairs and maintenance on the property. So no additional expenses. And they pay the property tax. So there's no additional property tax. So there's no additional fees other than your initial investment to purchase the property. And then you have a guaranteed rent over the years, and all your costs are covered. These, you don't mortgage these, you buy these cash. So for example, the one we use here is in Northeast England. For 168,000 Canadian or 93,000 pounds, you get a freehold, 2-bedroom, 1-bath renovated house. You have monthly income guaranteed amount of $1,200 per month. And that works out to a 9% yield. And there's no additional expenses because the tenant, which is the city, covers those additional expenses, which is your property tax and your property tax and any repairs and maintenance on the property. So Ed Scott is the go-to person for these. He has worked significantly in England and then relocated to Canada. Hint, he married a lovely Canadian bride, so that's what brought him over here. He's done over 1,200 property transactions, $200 million worth of transaction properties values, sold in 12 different countries, clients in 54 different countries. And he's established a FinLock to help Canadians invest in the UK. It's really what I see right now, especially with our geopolitical climate, diversifying assets into another currency, but still real estate is very important. When I look at the different government models, different banking systems, the UK and Canada are very similar because our system is based on the UK model because we were traditionally we were a colony of the UK. So our banking system, our government system is all based on the UK model, and that makes transactions very seamless between the two countries for when you're looking at investing. So what Finlock does, they help create these opportunities. They also have the management as well for these properties. And when you decide to sell the properties, they can assist on the sale of the properties as well. So you get that full service from them. So you know that you have a point of contact. You're not in this transaction on your own. They also have all the professional services associated with it, which is mortgage, legal, accounting, etc. And you can do everything from home. So why invest in the UK? Economic diversification, currency diversification, like I was saying. And where I look at things going right now in regards to what has happened with elections south of the border, I predict two things to happen. And we're already seeing it play out right now. And it's in relation to our dollar. Our dollar currently now is at a 4-year low. And the policies that are coming into play south of the border, which are our largest trading partner in the US, there will be some inflationary pressures that hit the market with the policies that are going to come into play. What will happen with those? Well, that means we may see a larger divergence of our two interest rates. The US economy is doing pretty good. The Canadian economy, not so. So we will be forced to continue to lower our interest rates, and the US market may not because they will continue to have a strong economy. And when you see a divergence of those rates, number one, that's when you're going to start seeing our dollar go down in value versus the US dollar, which we're seeing right now with the 4-year low right now on the Canadian dollar versus the US dollar. Number two, the policies also south of the border are pro drilling for oil. And how does that impact Canada? Well, that will lead to an increase in the oil supply, as well as they're predicting weaker demand for oil come 2025. So you're going to have more robust oil drilling in the US with that pro policy, which will increase the supply of oil in the US, which will overall have an impact on the value of oil. And what does that do? Well, because we are an oil producing nation, that's also going, and our dollar does get impacted by the value of oil. If the value of oil is going down, that can have a negative effect on our dollar value. So you get a double whammy in regards to divergence of interest rates. And with oil prices going down, commodities going down, that will then lead to a decreased value of our dollar. So a double whammy in that situation. So what you want to be is you want to be diversified away from the Canadian dollar. Because with the value of the dollar going down, that's going to impact your worldwide net worth. Say you want to take a trip to the States and visit Disneyland, for example, it's just going to get that more exponentially expensive. So you want to make sure you got a diversified income spread in your portfolio. And that's, again, where I see the pound, where we see future trade going to Europe, and it'll start going through Britain, which is a strong partner to the US moving forward. So I kind of went deep into that side of it, but that's where I see diversification of your portfolio into another currency is important. And then when I look at the UK offers a very similar banking system to the Canadian market, government system, taxation system, because our systems are based on each other. So it really creates a seamless transaction between the two. And when we look at not our money, but institutional money. What do we mean by institutional money? I mean pension funds. I mean large billion-dollar REITs. They're investing in housing in the UK because the UK has a severe shortage of housing. I've talked to colleagues and associates in the US, and they have the Manchester area specifically circled because they're severely underhoused in that area, and they're building massive buildings in that area, and they see huge upside in that area. So you have Canadian pension funds investing in the UK real estate for 30 plus years, CPP, Brookfield, Starlight. So there is people and large organizations that have larger payrolls than us already investing in the UK and continue to invest in the UK. And what better than to follow big money with our little money and reap the rewards. So what is investing in the UK social housing? And again, why I really like this. And I don't like using the word a guaranteed rate of return. But what it is you own the property in your name. So let's say I were to secure one of these assets. It's going to be, when I'm looking at the title, the deed, it's going to say Alex Wilson on that. That's mine. There's no other name on that. That is mine. Versus when I invest in, let's say, a fund, and a fund says, hey, you're going to you're expected to get this rate of return, or they guarantee you're going to get X rate of return. It doesn't mean anything. Your name isn't on anything. And if they were to go under, you would lose everything. Here, you're backstopped by the real estate. The real estate is in your name and no one else's name. So that's why I've always liked real estate and invested in real estate in my own name or a corporation that I own, holding company, because everything is in my name and it's all backstopped by the asset. Oh, there we go. Okay, whoops. Just have to wait for the little lines to pop up. Okay, so there are 1.4 million vulnerable people currently on the social housing wait list in the UK. 155,000 new social homes required every 20 years to meet this demand. The UK government has spent 1.7 billion pounds on temporary accommodations for these individuals. It's $100,000 pound cost to the government for each unhoused vulnerable person. So that's why they want to invest in these housings, because it gets vulnerable people off the streets and off their system, and it's more affordable to them. So there's a UK social housing shortage. The government cannot build enough houses. Not possible. They just do not have the materials. They don't have the labor. They just can't build these houses. So that's why they're employing alternatives to house these vulnerable people. And that's where you have these long-term leases with private landlords. So again, you're buying a house and then you enter in a long-term lease. It's all managed by someone else, guaranteed rate of return. You don't need to worry about anything. And these assets can be sold in the future as well. How does it work? So the housing provider, so you have a company out there that goes, secures the lease, fixes the property all up, house is all renoed. Then you buy the property off of them, you get the immediate monthly income, and the house is yours. So you're getting a turnkey solution with a lease in place right off the day one. And for 25 years, you're going to have an asset with income coming in, again, in your name, with no additional expenses, because those expenses are covered off on by the government that's paying for the lease. So the investment highlights 25-year government-backed income, hassle-free ownership, freehold property title. That is as simple and as attractive as I can make it, because it's government-backed by the UK, fully managed by the leaseholders, and then you own it free and clear. Pretty incredible. Better than a GIC. So they fund security, outright ownership of real property from day one. No running costs to housing provider, responsible for all the maintenance and management costs. No void periods, monthly income direct from the housing provider regardless of occupancy. Inflation-linked income, your income increases with inflation every year, CPI linked. So you're really covered off on all bases. And a tangible positive impact. So when you look at, in regards to, if you put a morality code in your real estate investing, your property provides a safe, warm home for vulnerable people. Your investment portfolio, on top of providing a great return in my eyes, is actually helping people. So who are the individuals that are typically living here? Victims of domestic abuse, asylum seekers, fleeing war-torn countries, adults and children with learning difficulties or mental health challenges, homeless families and individuals. Again, you're not handling the property. The housing provider, which is the council, is handling that. You're not handling any of these things. You just get your monthly income every month for 25 years. So the two areas of this is focused on is in Northeast England and Northwest England. And to give some examples here for pricing. Here's one located in County Durham, Northeast England. It's a two-story terrace house, just under 700 square feet, 2 bedrooms, 1 bath, fully renovated, $161,000. You get an annual income on that of $14,500. Your monthly income works out to $1,200 per month. It works out to a 9% yield, 9% on your initial investment of 161 every year, guaranteed for 25 years. And again, because it is indexed to inflation, this is what it looks like over that period. So your ROI actually, your yield actually goes up. So it starts at 9% by year 25 on that initial 161,000. Your yield is up to 14.5%. And your total ROI over the period is $288,000. And your total income is $464,000. So think of it as you've invested 161 and then over 161,000, and then over a 25-year period, you're getting $464,000 back. Sorry, my screen, I keep on having to move my screen bubble so I can see. I'm going to minimize myself. I don't need to see me. There we go. Okay, that makes it easier. So this is a Manchester example. This is in Manchester, giving you an idea of the renovations, what the properties look like. This is located in Greater Manchester, Northwest England, a 2-story end terrace home. It's got 5 bedrooms, 4 bathrooms. This would be £277,000 because it's a larger property, so it's more expensive. So 500,000 Canadian. But again, the annual income you're providing is $49,450. So it works out to a 10% yield, and its monthly income of $4,120. Again, indexed to inflation. So you look at this, you're going to invest just under $500,000 Canadian in this property, and then over that period, you're going to be paid $4,120 per month. What does that work out to for a yield over 25 years? But well, the yield over 25 years, or the ROI over 25 years, $318,000. So that initial just under $500,000 you're putting in, you're going to get back nearly $1.6 million back. And by year 25, you're looking at a 16% annual yield on the property. Again, property you own in your name, that there is no other additional costs of the property. All the repairs and maintenance and property taxes are all handled by the leaseholder. And you are getting monthly rent every month. To me, it is a great way to generate cash flow, positive cash flow that you can tangibly use, whether you're looking to diversify. And then the way I looked at it, and the investors that have went in here, they've had some Toronto assets, let's say, that are negative cash flow, and they offset the negative cash flow with one of these properties. Or, for example, they just want to, hey, I'm going to put this much money in the market, and then I want to live off of that money. That's what you can do with these as well. So it's a pretty powerful tool to generate cash flow in an asset that you own. Again, and then that's also going up in value as well. This is another example, larger asset class. This is where you're actually buying a children's care home, or something where you're looking at, well, I don't have the Canadian dollar amount there, but 1.34 million pounds. So annual income from that is 213,000 Canadian. The monthly income of that is 17,700, just nearly $18,000, working out to a 9% yield as well. So great opportunities, again, having these government-backed leases on the properties and then living off a rate of return on these. Your partners on these are, you definitely have some names that you recognize of YMCA, Bright Start Homes, ROC Group of Companies, Positive Directions, Bailey Capital. It's pretty incredible that you're able to get into these assets that give you a rate of return on these. So I'm just going to stop my share of my screen. There's obviously a Q&A box down below. I've done this presentation a few times with Ed, so I can help people answer questions. If they get too detailed, I'm going to say, hey, Ed is going to book a one-on-one call with you to get into details. But it's something that's pretty powerful. So if you have any questions, you can ask them in the Q&A box. I notice Area is asking a question. So Area, you raise your hand. You can just put the question in the Q&A box down below. And happy to answer any questions. I'm sure there's going to be some questions here about this product and an investment vehicle. Area, did you figure out how to get into the Q&A box to ask the questions? Oh, there we go. I think the question popped up. Can you talk about the liability implications, insurance on the property? I'll confirm the insurance question, but again, I believe the insurance is going to be actually going to be held by the tenant that is in place. So I'll confirm on the insurance side because these are commercial leases on the property. But again, your liability is you're basically an overseas investor that holds the property. But I'll get a better answer for that for you. Actually, let me see if I can just message Ed on that and get a clearer answer on that. Oh yeah, here the questions are flying in now. That's great. Okay, let me just ask Ed that question. Okay, let's continue on with the questions. Yeah, you're not getting mortgages on these, so there isn't mortgages available on these properties. So that's the answer why you can't get a mortgage with these properties. If you wanted to invest in the UK and buy a more traditional type mortgage, traditional type property, be it a condo in the sky, absolutely you can buy one of those and you can get a mortgage and you can get a mortgage from a UK bank there. So if you're interested in more traditional assets, there are more traditional assets available, but they're not going to provide the same rate of returns as these are providing. So for example, if you wanted to buy a pre-construction condo in Manchester, is that something that's available? Absolutely. You can buy a pre-construction condo in Manchester, something that's brand new, and just have that standard type of property. You can do that. It's just that the banks aren't offering mortgages on these. After 25 years, I imagine the property will need a total reno. Is that cost somehow taken into account? I will say, after 25 years, any property you invest in will need some sort of updating. So how you factor that into your investment calculation, you can. It is not factored into the rates of returns in this. But any property, whether it's one of these houses or whether it's a condo in Toronto, in 25 years, it'll need some sort of update, but that's not factored into the numbers. Tax implications. The tax implications, you have a tax treaty that's with Canada and the UK. So they balance each other out. There's no additional tax consequences to you, meaning that you don't pay extra tax on it. Now, there is a way to do it if you own a UK-based corporation, and that UK-based corporation, your effective income tax drops down to around 19%, approximately. That's obviously deeper layers and everything like that, but you can buy in a UK holdco and get your tax rate down to 19%, and then your money is staying in your UK holdco. So that is an option to get your tax rate down on these properties. What happens if you don't have the full cash value to buy something? What tends to be the lowest cost for properties like these? So the lowest cost would be the example that I gave, the $161,000. So my answer would be to find a partner then that would help make up the difference in these properties. So you would need to come up with that full amount to invest in this asset class. So the answer would be you'd have to find a partner to help give you the rest of the capital, and then you'd be investing in it jointly. Uh, and what's the process of sale? Can you sell mid-lease? Absolutely, you can sell mid-lease. These are transactional assets. So Aria, for example, let me see again another. I see Irma. So let's say you're 5 years in, Aria wants to sell this to Irma. You can sell it. You can sell it to Irma and whatever the fair market value of the asset is at that time. So completely transferable and sellable. And that's the beauty of it being in your name. So you're owning it in your, whether it's in your Aria's name, whether it's in a company controlled by you, it's fully transferable, and you would just sell the asset. That's all you're doing. It's an asset that's sellable. Uh, so I will say, these are we started doing these this year, and it was interesting. I text a client that bought three of them, and I said to him, I have it was another opportunity coming up in Ottawa. I'm like, I have these great Ottawa pre-construction townhomes. He's like, I'm not interested in buying anything in Canada right now, but I'm loving these UK investments. Um, because he's an established investor here in Canada, has bought a number of condos, and he wanted to diversify into cash flow investments. He has family and connections in the UK, so it wasn't something that he went into blind, and he was able to make the investment comfortably there because he was just looking for something that generated positive cash flow. That's why he was tired of the Canadian real estate market and buying assets that were focused on appreciation but didn't do anything for cash flow. That was his excitement in there. And to give you an idea, demographic of the individual, he was in his mid 40s, similar to me. So I completely understood where he came from. 9% doesn't seem like a high amount for a large investment like the cost of these. I think like if I'm looking for 161,000, I don't think that's a large investment at all. That's your down payment for a Toronto condo. And your rate of return on those is nowhere near 9%. You're never going to get 9% on the cash flow. And if I took $161,000 and I put that into a GIC, I'm getting under 5% on that. If I took that $161,000 and I put into the private investment market, am I going to get a little bit more money? I may get a little bit more money, but incredibly risky. It's not government backed. So the idea is you're 9% government backed. That's the key thing. Can I go find something that's going to give me 20%? Yeah. But guess what? That's more risky. There's risks associated with that. So you could lose everything. Look in the newspaper. Look in regards to um, fortress developments in regards to everyone that lost all their money gone, gone. So are there things that could give you a higher rate of return? Yeah, but there's risk associated with with these government backed. That's the easy thing. Now I do have the answer on the for the insurance. Buyer gets insurance policy in their name, which they arrange. Cost is refunded by social housing provider at the end of each year, so net zero cost. So there's your answer. You will the insurance policy is in your name. You get the insurance policy, but then that is then reimbursed on top of the net income that you're getting on the property. So that's an expense that is reimbursed. There's no extra expense on those. So again, tax implications. Same thing. There you have a tax treaty between Canada and UK. Canada and the US kind of similar. There's no additional tax. How these tax treaties works is that you're taxed up to here in regards to one country. And then if you have to pay a little bit more in your home country, you pay a little bit more in your home country, but you're not paying more than if you own the asset in Canada. That's the key thing. But if you had a holding company, you can get that net rate down to 19%. The body of government that guarantees the income. It's council, so it's at your municipal level. No, there's no funding or loans on these. These are cash purchases that you're buying on these. So you're looking at, again, if you were to buy a condo in Toronto, I will just use the Toronto example again. You're looking at your capital investment. Let's say you're to buy a $500,000 condo in Toronto. I'll just say that. $500,000 condo in Toronto, 20% down payment, that's $100,000 right there. With your land transfer tax on that asset and other closing costs and everything, you're probably around 120 in it to buy an investment condo in downtown Toronto. You're looking at 161,000 on the entry level one of these. Your numbers are the same in regards to buying an asset. The difference is you actually get a rate of return that is very attractive with no additional cost going forward. Lenders won't lend on them. That's the answer. You don't have a lender that's going to lend them. I'll give an example of where you can't get a mortgage on something here. There are certain buildings in Toronto that banks won't lend on. Banks don't like, let's say, for example, hotels. They don't like hotels. So it's very difficult to get a mortgage if you're to buy a condo in One King West, for example, because it's a hotel-based entity. So it's just how the banks view their risk and what different property asset classes they invest in. Could there be potential in the future that they give mortgage on them? There can be, but they're not offering mortgage on these right now. You can't get a mortgage on them. But the idea is you don't want the mortgage on them. You want the cash flow. Again, if I'm investing $161,000 and I'm getting a 9% yield on it, that's government backed. That's again absolutely incredible. Look at bond rates and everything. Like that is a great rate of return. This is long, boring money. It's not get rich quick money. This is long, boring money. If you like long, boring money, and that's how people should view real estate, long and boring. Long and boring is very important. When we look at the period that we just went through in regards to higher interest rates, these are great tools to help protect your portfolio from high interest rates. I will put up my hand. Is my portfolio cash flow positive in Toronto right now? Absolutely not. I can say my portfolio right now is probably negative $10,000 per month. That's what my portfolio is looking like right now in regards to the rent that's coming in and the expenses that are going out. So here I have an asset class which is providing me a 9% rate of return that could then offset my negative cash flow that's coming in from my investments that are exposed to interest rate fluctuations. Someone's asking the questions why banks won't lend on it. They're just not lending on it. I will tell you, do you think land is risky? Guess what? You can't get a mortgage on land. Banks won't give you a mortgage on land. It doesn't happen. So banks will do what banks want to do. Banks are conservative and banks are going to lend on what they want to lend on. That's the reality of these situations. I'll let anyone else ask any questions. I'll leave it open for 2 more minutes. But again, if you're looking for long, boring money that's government backed, these are some of the best things that I've seen out there that you can invest in. because it protects you. It's looking at hedging your real estate portfolio and getting a positive rate of return. I will tell you, all condo investors in Toronto are underwater if they have mortgages on their property. That is what you're looking at protecting against. How do I know governments won't change their mind in the future about backing these? Well, you have a 25-year commercial lease on the property. So you have an existing lease that's on the property. So you're signing a contract for 25 years. If they stop doing these in the future, that's even better because now you have a scarce asset they're not investing in anymore. So again, you're protected by a 25-year government backed entity. Just like if you buy a bond at a set yield, that bond is at a contracted rate. If the government doesn't want to issue bonds at that rate anymore, then they're not issuing bonds at that rate anymore. And now you have a valuable asset, that's scarcity, but they can't take away what you already have. Let's say the legal world protects you in that case. These are legal contracts that you have. Well, thank you everyone for attending. There's going to be a summary of this, and then you'll have an opportunity to book a call with Ed, and he can get more in depth in regards to the questions that you may have on these. But again, I think they are incredibly powerful opportunities. So thank you so much. Again, there'll be a recording of this sent to everyone. Okay, thank you so much. Have a great day. Bye.